If you're looking for cash flow, doing year-end tax planning, or just trying to dial down your exposure from the stock market, you already know the real challenge is figuring out where you can put your capital safely. The stock market is experiencing serious volatility. A lot of commercial real estate deals haven't performed over the last several years. And depending on who you talk to, it's either the best time to deploy capital or it makes more sense to sit in cash. So as an LP, you're stuck asking, what assets make sense for me? Who should I invest with? And how much should I actually deploy? And this is exactly why I wanted to bring on Bronson Hill. He's the founder of Bronson Equity, and he's raised over $40 million across multifamily, oil and gas, precious metals, developments, and more. He's a co-GP on over 2,500 multifamily units, and he started inside the industry working directly with operators at Nighthawk Equity before building out his own platform. And today's episode isn't just about Bronson's story, it's about giving you clarity in a messy market. And so we're going to walk through how he evaluates operators and structures before raising a dollar, what he's learned from syndicating dozens of deals, the wins and the hard lessons, why he's shifting from pure capital raising towards having more control as a general partner, and the exact due diligence process he uses today so that investors don't get blindsided in his deals. We're also going to talk about the modular housing project he's working on in Altadena, California, after the fires, and how he is positioning his own capital going into 2026. So if you're an LP trying to deploy capital intelligently, if you want to understand how operators think behind the scenes, or you just want a better framework for evaluating deals in this environment, this episode is going to help you get grounded. And with that, let's dive in. Bronson, welcome to the show.
Pascal, really good to meet you. Good to be here. I know we know of each other, like we've actually met, so it's great to be able to connect with you on this platform, and looking forward to the show.
Yeah, man. So I would love to dive right in. We're going to cover a lot of ground today, but I think you have a unique perspective where you came from medical sales. You did something before real estate. You then got into worked for a general partner with Michael Blanc at Nighthawk Equity for a couple years, and then you went out on your own. I would love to kind of just walk through that journey a little bit so that people can understand what that looked like and how that informs how you make decisions today.
Right. Well, thanks, man. I appreciate that. Yeah. So I was a well-paid medical sales professional. I was making over $200,000 a year in my job, and I liked what I did, but I didn't, every single quarter when I would do well and I won awards and things, and there was a lot of positive things that happened, but it'd always be kind of a slap on the back, be like, great job, now do better next quarter. And it's that idea of a grind, right? That we all kind of know if you've ever worked corporate, whether it was a sales or something else, that there's this desire to just perform and just, you've got to be bigger, better. And you're just a number and a cog in a big machine. And so I wanted to do something different. And so I was really, I worked with a couple of physicians that basically were making, a couple of these guys were making $2-3 million a year each. I mean, these cardiologists, they were doing just amazing work and it was great and people were being helped, but they were working 70, 80-hour weeks. And I just thought, that's really not financial freedom, because if they don't go to work, they don't get paid, even though they're getting paid a lot. And so I didn't see it to me, financial freedom really meant time freedom. So I started to learn about, real estate, did a little bit of single family, realized I was creating for myself another job. And that's what a lot of people realize. A lot of LPs realize when you own 1, 2, 3, 4, 5 rental houses, even if you're a property manager, you're basically creating for yourself another job. And so I was doing that. And then I learned about, there's that saying, when the student is ready, the teacher appears. So I basically had a friend who introduced me to multifamily, and basically learned about raising capital. And so I used my skills of just being able to connect with people and being able to kind of educate with my sales background. And now we've raised, actually now it's over 50 million. We have 2,500 multifamily units, and we're doing different types of projects in and out of real estate. And so I approach things as an LP, and I also approach them as an investor or a partner. So as a general partner. So I just love being able to be a part of this conversation, really helping people to grow.
Hell yeah. So I would love to dig in and just understand, when you worked with Michael, what were some of the things that you didn't really anticipate or were nuances of being on the capital raising side of working with an operator?
Yeah, so it's interesting. We see people do all kinds of stuff, and they seem to be everywhere, and we see them on social media. And we don't realize, it's funny when I actually met Michael, who I worked with for a few years as an equity partner, I met him. I'd already spent all this time with him from his podcast, and so I'm a little bit gregarious, Pascal. So when I showed up, hey, how's it going, man? And he didn't know who I was, and so he was a little taken back, and I realized like, well, he doesn't really know me, and so I realized that we're in a time now where just like with this show, you probably people come up to you and me as well. Where it's just like they'll feel like we're best friends, and I've never actually had a conversation with them, right? Or I don't really know them well, and so
Right.
it is amazing. We're in a place with kind of this one-to-many conversations, right? You can have hundreds or thousands of people listening to this conversation, while it's being recorded later. And that's just a really interesting thing. Now we're in a time where it is really golden age of getting your message out there. There's people that are really now with alternative media really looking for sources. We feel like mainstream media and Wall Street and other things just really not serving us, and so it's finding those alternatives. So I think with Michael, one thing that he did exceptionally well is he was really great at creating systems and processes and really thinking about, okay, how do we get from a podcast that's a successful podcast, get people to actually want to invest or do a mentorship, or how do we work them kind of down that funnel? And he was really good at it. So I just saw things I'd never seen before, and that I look back as being really instrumental in my success, is just kind of seeing and learning how all this stuff worked. And so when I was working full time, I literally was working full time, and I was doing these phone calls with investors. I had 1,000 one-on-one phone calls with investors over 18 months while still working full time. So this is like Zoom calls, like for 30 minutes in the car at lunchtime, 6 a.m., taking a Tuesday off, stacking 20 calls back to back, and just getting as many reps in as I could. But I learned a ton, and I think that's one thing that was really valuable from that experience.
I have to imagine there is a little bit of a weird feeling that you kind of have to stake your reputation or your relationship with all of these new investors based off of the deal that your partners or the GP decides to do, whether maybe you know enough about them or not, or whether you agree with going into those deals or not. Talk talk to me a little bit about that.
Yeah. So what we do now, I mean, we really look and see, what is the specific deal. We have a whole process in my book, Fire Yourself. I've got it on the shelf behind me here. But basically, looking at a deal, how do you vet a deal is right for you? How do you know it's the right operator? How do you know it's in the right market? There's so many things that can go right in a deal, and there's so many things that can go wrong in a deal. And so it's just really important that you have just kind of this, idea hat on where you think, well, what are all the things I think could go right? What could go wrong? And then I think, we get approached a lot. I'm sure you do as well, Pascal, where it's like we get all kinds of people wanting us to raise money for their deal, especially these days because capital is getting a little harder to raise. And it doesn't mean we're going to bat 1,000. We had deals where we've had absolute home runs. We had one deal we bought for 27 million. We were a partner in that, and basically we sold it for 37 million. 10 months later, it was almost 100% return, gain for investors. Incredible. We've had other deals that have been total losses, right? So it's like, so we have it everywhere in between. Things perform as expected or better than expected or slightly worse. And so I think that one of the things we look for is when it comes to a partner, because or a deal, is just, what does this deal do? Is this deal something that fits my goals? Is it something that fits what I want? Most people, it's one of three things. It's either cash flow, it's tax benefits, or it's depreciation. If you're somebody who's making hundreds of thousands or millions of dollars, you likely have a tax issue, right? So you've got to find a way to reduce taxes. So things like oil and gas, things like different strategies with the IRS of being a real estate professional or having your spouse be a real estate professional. Those are huge, right? So finding deals that can help take advantage of those. Other ones might be cash flow, right? Just I know a guy's worth over $500 million and he loves cash flow, right? Because it covers his living expenses. Somebody who wants to fire themselves or wants to leave their job or sell their business, cash flow is what allows you to be able to do that. It covers your living expenses so that you can actually be able to live well. So I think that, there's no real secret thing to it. I think when it comes to the sponsor, I have kind of a process for that. I'm happy to talk about that. But I think, getting into exactly what type of deal you want and how to analyze deals, I think is incredibly important what we do.
Yeah, tell me. I would love to kind of take that into the angle of like when you worked with Michael, um, like what was that like? Because I imagine that you have to go along with what they decide to do in the beginning when you first get into the industry.
Yeah. Yeah. So when I first worked with my partner, I was more junior to it. I had an investing background from just doing, I was a registered investment advisor and RIA. Now I call myself a recovering investment advisor. So I'm not an investment advisor anymore, but just kind of saw on the other side. But at the time, we were actually pretty well aligned. I think we were looking for value add multifamily deals. We had some great exits. We had some great deals. We did. We're really happy. I mean, it wasn't. We kind of trusted different members of the team. So we had a guy on the team who really focused on acquisitions, and we would do things we got really excited about. And so I just kind of stayed in my lane a bit. I think that's one thing I'm good at is just, hey, if I'm good at this, I'm going to stay here. I'm going to go here. Now I've noticed, and we can talk more about this. We've had some deals that haven't gone as well, right? So I've had to take some reflection on that and be like, okay, what happened here? So there are black swan events such as interest rates rise faster than they have in 45 years, and so if you put 20% down and your property in Atlanta is now worth 40% less 2 years later than when you bought it, that's a big problem, right? You're negative equity no matter what you do, right? And so there's
Yeah.
issues like that come up. So it's interesting. A lot of people, we talked about this a little before we started. There's the idea a lot of times to want to blame, the market, blame the person, the sponsor, the whoever, and a lot of us just look at it like, we're learning, we're growing, and if you are blaming, it doesn't give you a chance to learn and grow. And so I just look at everything. In my book, I talk about this. I had a deal where I lost $70,000 in one day doing an options trading strategy, right? Just me, myself, just investing. And this was like a third of my net worth at the time. This was years ago. And so it was very difficult, but I learned I'm not a great options trader, right? I'm probably not the best guy to be working that for me. So I figure, okay, I'm going to learn from this. I'm going to move forward on things that can help. So a wise person learns from their own mistakes, right? What am I learning here that I can apply?
What are some of the key things that you learned working there that you maybe took with you when you went out and started your own company doing this?
Yeah, well, I actually had started before I started working with my partner. I'd kind of been doing my own thing. I had my company. I started to launch some things, and it wasn't really as effective as I wanted it to be. So then when I worked with Michael, I just learned, oh wow, there's actually more effective ways to do this. And so I took a lot of it. One of the big things I've taken away is the avatar, right? The idea sometimes is we want to feel like we're reaching everybody everywhere. Like, well, who's your deal for? What's for everybody everywhere? Everybody can learn about whatever. It's like we've got it dialed down now to where we've got an avatar. We literally got 16 pages of description about this avatar. We've got a name. His name is Marcus. What his net worth is, what his kids, do, what his biggest issues are, his fears, concerns, ideas, what his emotional stuff is going on, what's going on with him. And it's like all this stuff because we want to put everything we do through that filter. Because if you can reach somebody like Marcus, that's the ideal person we're trying to reach, then you're going to reach a lot more Marcuses and you're going to be way more effective. So I'll give an example. I have a good friend of mine who has 500,000 followers. He talks on economics. He's a well-known guy. You might know his name. And he talks a lot about Bitcoin and other sorts of economics. And really, really bright guy, super smart. And he looked at me, it was about a year ago at a conference. He says, Bronson, how are you raising so much money? We raise typically about 10 to 15 million a year. So how are you raising so much money? And I said, well, we hyper focus. We focus on this one type of person, usually a business owner that has these type of issues, and we focus in. And because of that, it speaks to people, right? We don't need, 500,000 followers. We have 3,300 followers on YouTube or something. We don't have a lot of followers, right? But we've got the right kind of followers. We got the people that they invest in every deal. They follow what we do because they trust us, right? And it doesn't mean we're perfect. Doesn't mean we haven't made mistakes, but when we have that type of, we can really speak to people. We can have those authentic conversations because at the end of the day, people think they've got to be all this, I've got to have it all polished and all together. But people aren't drawn to polish. They're drawn to authenticity. They're drawn to like, am I getting the real person? Is this person actually being honest with me? Somebody I've never met. That kind of shocked me. Somebody would invest $100,000 with somebody they've never met. That's crazy, right? Why you said,
It
oh,
is crazy.
it's
Yeah.
crazy. I've had somebody invest $1 million one time that they never even met me, right? They just threw a referral. And so, that it's amazing what trust can be built. And it's just built through you just simply showing up and being authentic and talking through what's happened. And here's actually who you really are. Because in this world, like we have so much AI and everything's fake, deep fake, everything, videos, all this stuff. It's going to be more and more important that people are just authentic and you feel like you're getting the real person.
You touched on something there, which I think is worth double clicking on, which is this idea that when you get into this industry, really, you end up wiring hundreds of thousands of dollars to complete strangers you've never met on the internet, and um, and I've now invested personally 3.3 million at this point into all of these deals, and I've probably only met you know, two or three of the 23 different operators that I've
Right.
invested with. And I think first off, when you start, you don't know what to ask, or what to look for, or what are the nuances. But also just this idea that you somehow need to do enough research to feel trust enough to make an investment. Do you have any kind of insights into that?
Yeah, I used to think it was absolutely crazy. You'd hear somebody on a podcast, and then I'm going to invest, $100,000 with this person. Sounds crazy, right? But I think that the thing that we look for is, obviously there's things we look for in our sponsors that we work with, or partners, or when I invest passively, is just, well, who is this person? What's their reputation? And I think that's something too. Having been grateful to be around for a while in the industry, you kind of know a lot of people. And even if I don't know somebody, if I kind of know somebody that knows them, there'll be some reputation there. And that's really helpful. Often, we get, like I was sharing, we get a lot of offers for people to, for, wanting us to bring capital to their deals. And we say no to at least 95% of them, because we either don't know them, it's not the right fit, it doesn't really fit our group. But when someone it is compelling. We had a deal we did with an operator I've known this guy for 6 years, right? I know people that have invested with him over several, a number of years. And I've always had a lot of respect for this guy. He's got a great reputation. He's really developed a great firm. And so we partnered with them on something, and it was a good experience, right? Because we've had some just getting to know you time. We've talked to other investors. The best way to learn is having had experience investing with that group. So sometimes I'll passively invest with a group and then kind of get a little experience first before we bring it to our investors. Or I'll have somebody who is an investor who says, "Hey, here are these guys. These guys are awesome." And then I'm like, "Oh, interesting. Well, let's learn about that." And so, because the challenge is there are a lot of great operators out there. There's also a lot of bad operators, a lot of scammers out there, a lot of people that we just don't know. And so I think it's almost like dating, right? You should give yourself some time before you get married. You shouldn't just like go on a date and like, okay, I'm gonna get married. So let's just kind of like get to know each other for a while. Let's spend some time in person. Let's kind of find some people that know you. Let's get to know these people that, like, what do they say about themselves? What do other people say about them? And those are all kind of ways that we help to vet an operator. And I think what someone says about themselves on their website, how they communicate. A lot of operators, I used to think everybody wanted to communicate really well. A lot of operators want to raise money and never hear from investors again. And it's the worst experience if you are a passive investor and you need information or you want to reach out. That's really difficult.
Yeah, there are a lot of also new tools, thankfully, springing up. Like there's the Invest Clearly, where you can look up a sponsor, people leave reviews. There's, I know there's like been the 506 Investors Group, Passive Pockets coming out with a review platform. Best Ever has a spot where people talk about deals and sponsors that they've been in. But really, yeah, you pretty much have to. How I think about it is, you need to triangulate data about a sponsor or a deal from as many different angles as you can, to try and see, like, are there any flags? Is there anything I'm missing? That's at least how I do my due diligence process. And I would love to. I mean, I have a different question after that, but I'd love to understand, how do you think about that? Like, to me, I'm having a big checklist. I have a 100 point. It's actually more. It's more like 150 at this point. But it's like, first I'm looking at, what can I learn. I have a set of questions of what I can take away from a deck or from a webinar, and then, if I'm still interested in the deal after I've gone through that initial stage, then I'll schedule an hour-long call with the operator, and I'll try and get the remaining of my questions answered. And you just kind of see, how do they communicate? How do they react? Like, what do they give good answers? Do they skirt around certain issues when you ask them point blank about, like, do they have any pending litigation, or like, um, what does their body language say? What does your process look like?
Yeah. So I mean, I think, it's good to have, are you an engineer by background or a pilot or
I'm a
just
systems guy for sure.
okay, I guess
Yeah.
you answered that like an engineer. I was like, oh, 100 point, 150 point checklist. And I think that's good. I think it's good to have specific things that you ask, because I think it helps you to have a process. I think for a lot of investors they don't have a process. I'm just going to call, they look, I like what they're saying, whatever. I think it's good to have some questions you ask. Hey, tell me about a deal. One question I love is, tell me about a deal that didn't go well, right? How did you handle that? And if they say, oh, everything's gone great, either they're inexperienced or they're not being honest with you, because every deal, as you know, like, no deal ever goes kind of as planned. Things go better, they go worse, they go other things. So I just think it's that whole question: am I getting the real person? Is this person showing up fully? I do like speaking with other investors. I think those are, because you can ask people a ton of questions, but when you speak with someone who's actually investing with them. And it's actually best if it's somebody you can just kind of find on your own, or like word of mouth, because it's not like
Or on
a
a
curated,
forum.
or on a forum. Yeah, it's not a curated thing. But I mean, the challenge of all of it is, I think, what am I looking for in a sponsor? I'm looking for somebody who's going to communicate well. A deal may go well, it may not go well, right? But are they going to keep communicating? And do they have, I mean, sometimes I get a little concerned when someone's like, everything's always gone well all the time. And if that's the case, like, is that really a too good to be true feeling? I found that sometimes with people, like, if it seems too good to be true, sometimes it is. And so, if somebody seems like, I know actually sponsors that they only talk about how they sold their stuff before the market crashed and they did this and they whatever. And it's like, the only stuff they're sharing is positive stuff. And you think they like walk on water or something. And I'm thinking like, well, what happens if the person ever has a problem? Do they not share it? Or they like, and so I'd rather have somebody who's a little more real than somebody who's just always done everything perfectly. But I think everybody kind of has their own approach. And I think it's good to get a question, the really sense of, okay, from a character perspective, who are these folks? From a track record experience, is this a rinse and repeat type of deal? Because if it's something similar to what they've done, it may be easier. And rinse and repeat doesn't mean like, I did it in Dallas, now I'm going to, Louisville, and I'm going to do it's like, that's a whole different area, right? So you got to kind of think about, well, that's kind of a different setup, because they have a different property management team, they have a different group of people there, so they may not be able to replicate, right? So you just have to kind of understand that. And we're getting ready to do this deal in Altadena where I've done some fix and flips, and I've done some rehabs and buy and holds, but we haven't done this specific thing that we're going to be doing with modular and prefabricated homes. They're building a factory, bring them in. And so we're going to have, we'll do a couple kind of for other people, and then we're going to have people taking a risk on us, right? So I think at the end of the day, you're looking for honesty. You're looking for people that are who they say they are. They show up, and at the very least, they're going to communicate with you, and that hopefully they've been conservative. They're not looking for pie in the sky. They're looking for, hey, this is real world. Like, like we don't. Here's 3 things we didn't put in the numbers that could go right, that we haven't even put in there, but we're putting in a more conservative number because we'd rather undershoot and outperform than to do it the other way.
I think when I first started, my initial gut was, if anyone had any deal go sideways, that I wouldn't want to invest with them. And I think the more that I get into this space, I think I start to realize how unrealistic I think that is, because then you don't know where the booby traps are.
Yeah.
And I've been my own kind of real estate investor. I invest in single family homes and rent them by the room, and I have a portfolio in Atlanta. And I've taken one loss out of my 12 or 94 unit portfolio, and so you bet that I am definitely know what to avoid moving forward. And in theory, you would think that that all of my deals moving forward will have a better chance of being, getting risk adjusted returns because I've had a loss. How do you look at that? I imagine you also think about that a little bit as you're evaluating sponsors to partner
Yeah,
with.
I think before, I used to think a 20% or 18% return projection was better than a 15%. And now it's like, I mean, we're doing debt fund stuff with a great operator, 50% loan to value. And, it's kind of the 10 to 15% range. And I'm like, that's pretty great. Like, we're actually getting paid like equity was paying a few years ago without the risk, or like with a substantially less risk. And so, I don't know. I get, what are the signs of great sponsors, right? What are like the things when you see them, like you get a sense, of what they're doing. And I think one of them is they under promise and over deliver consistently. They'll kind of have a lower number. They'll have a lower projection. They'll be able to outperform on that. That's one. Another one is they communicate very well. We talked about that, right? They'll have, if something's not going well, they'll let you know right away. They won't kind of like, it will come out way later. They'll be available. They'll get back to you within a day or two on, hey, here's your question. Here's what I got. That's a good one. Another one is track record. They're open to share track record. They're open to share about challenges they've had. I mean, even my co-author, or my person who did the forward to my book, Ken McElroy, he's got $3 billion in real estate. He's had challenges. He's lost investor funds on multiple occasions, right? So I think it's again, this is investing. We're not talking about something that's perfect. You can't get it perfect. You'll do the best you can. But if it were easy, everybody would do it. If there was not really a risk of loss, everybody would be doing it. So I think that you have to kind of like continue to learn, kind of have lessons, maybe write down some lessons of why you're investing with this person, and then go back and check it later and say, well, how did it go? And what did you learn? And I think as an investor, it's not just the investment you're making, is you're investing really in yourself. You're investing in, how am I doing and how am I learning? What am I going to take away from this, whether it goes well or it doesn't go well?
Yeah, I mean, even people like Warren Buffett, there's a story where he invested like 400 million into Dexter Shoe Company, and that went totally sideways, you know, and yeah, so even the greats have mistakes. I want to talk about the landscape of capital raisers versus maybe like operators themselves. And I think like if you're new to this niche, then it's very opaque and you don't really understand, is the capital raiser or someone like you who partners with like other operators and institutions, what is their role, and does it make sense for you to just go direct? How do you negotiate or put deals together where it makes sense for investors to invest with you? Can you maybe pull that apart for us so that
Sure.
the newer LP can just get an understanding of how that landscape works?
Yeah, so it's interesting, the world of capital raising, right? So officially, you're not really allowed just to be a capital raiser for a deal and kind of get a certain percentage amount. And so we've always been either a co-GP, which means we have other, things where we manage, investor relations is kind of after you raise funds, or it could be you're doing stuff actually from the actual asset management as well. So we've done that in multifamily, and then we've had other projects that we've done what's called a fund of funds, or some sort of a like a SPV or a special purpose entity that goes into another project. Now, as an investor, as an LP, why would you want to invest with someone who is not directly the operator, right? That's the question we get sometimes. Well, sometimes we've had, I can share multiple examples of this. We recently did a self-storage deal where if somebody came in, and this is a $1 billion operator, if they came in at 100K, they'd get like a 6 pref and a certain split. Well, if they came in through us, because we're a larger group, we're writing a $2 million check. The operator loves it because we're coming in as one investor. So they give us a much higher, they give us, instead of a B share, they give us like a C share, which is actually higher. And so we take a little fee on it, right? Because we do diligence, we fly out and we do some work on it as well. And then we give them basically B share. So we give them the equivalent as if they had invested $1 million directly with this group, right? So we love those scenarios because then it gives the opportunity that people coming through us get a substantially better deal. So we like it in general that people get the same deal or a better deal than they would get as if they went direct, right? So if it's something that you invest with us, because again, the size of a group, the size of the check that we're bringing, and that's what we like. Now, the challenge of that, I mean, just to be transparent, for us is it's challenging. If you're a fund of funds and you bring 2 million or a few million to a deal, you don't have control, right? You're basically coming in as one investor, and so you're responsible. I'm responsible to the for the experience, to investors. But the challenge is I don't have control over the actual project itself. And so that makes it tricky. It makes it tricky to manage. But I think as an LP, you can figure, okay, do I want to be involved? How can I get the best deal in this? And also, do I trust, like somebody will just, people invest with because they trust me, right? They say, oh, Bronson's done his work. It must be a good deal. Let's do it. Right.
Yeah. So, can you walk through what some of that due diligence process looks like? You just highlighted a little bit of that. Flying out, maybe reviewing documents, walking properties.
Yeah. Yeah. So we have for different assets, and we do different types of assets. So oil and gas is a little different, right? We might, the oil and gas project that we're working on, we've done a few deals with a specific sponsor. We've been happy with the performance. This is somebody I've known for 6 years. I've known their family. I've spent a lot of time with them personally. We also do background checks. We look at reputation. We talk to other investors that have been involved with them. We make sure we understand, both their experience as well as just, what they're actually doing. Just in the conversation, is this person, I think the most important thing is this person showing up authentically? Are they actually giving us what we feel actually makes sense? Because if it doesn't make sense or something seems a little off, and you'll get a feel, like I'll get a feel, but you get a feel for people sometimes where you're like, this person doesn't seem like they're coming from the right space, like at the end of the day, like you can kind of tell, but it's like, it's really just about them. They really don't seem to be like, it's really about the investor. I think people can sniff that out. And so, so those are a few things. But again, it's different for different types of deals. If it's a real estate deal, we will try to fly out there or go see it. We'll do a tour. We'll look at competing properties, and then we'll kind of have our own little checklist, right? Of okay, when we talk to these guys, what is their experience? What's the background? What are the exits they've had so far? So we're looking at specific track record. We're talking to other investors. We're looking at reputation. So I kind of have more bigger boxes we look at, and then we drill down if we see any issue, we might go 10 layers deep on that one issue, right? So if we see any issue with reputation, we might go, okay, we're going to talk to a lot more people, right? Or we might just say, you know what, we're going to put this on hold for now, right? If any of these things start to kind of feel a little weird, it's like, let's just kind of set it down. Or there's something with the numbers. Let's see if we can make sure we can understand that. If we don't, well, then let's move on. Or let's wait. I think the best thing is just, unless you feel at peace about moving forward with it, and it doesn't feel, there's a guy, Eckhart Tolle, who wrote The Power of Now. He has this idea that sometimes there'll be a conflict where our brain will say, oh, everything looks fine, but our gut will be saying something's not right. And almost the time, even though the information is all there, our gut will end up being right, but the information said everything was okay at the time, right? So it's just, sometimes we don't know. So I think I like to pay attention to that. So I'm a little less, I got to go through all these questions, because you could answer all the questions on 150 questions and get them all right, and still the person ends up being a crook, right? There's no surefire way. But I think it's, are you asking the questions? Are you listening to what's them? Are you really, and are they willing to kind of have all those conversations with you? Because somebody who's dodgy is not willing to do that typically.
Yeah, I imagine your process has evolved quite a bit since you started. What's maybe some takeaways or learnings, or maybe like a due diligence mistake that you've made early on that you no longer make?
That's a good question. I think one of the mistakes we made, obviously looking back, you can learn a lot. When interest rates, rose quicker than they had in 45 years, they had that experience, Warren Buffett saying, it's only when the tide goes out you see who's been swimming naked, right? So there was a lot of like, oh yeah, we can do, the only reason some of these multifamily deals made sense was with bridge debt and 20% down. So they're highly levered. And then what happened is, as rates rose, sometimes we went from a 4 or 5% rate for a lot of people with bridge up to a 9 to 12% rate if they were going to buy. So it just dramatically it decreased the value of the properties, even in the same condition. And it's hard to believe that that could happen so quickly. But I think that's with investing. You have to be willing to entertain, what you don't know can really hurt you, right? So what is it that I can do? So I think just the assumptions you make of, for me, the big thing is, if we're going to do real estate deals, we really want to make sure we understand the debt. We want to make sure it's typically long-term debt, not, hey, a couple of years in extension, and can we get 6-year debt? Can we get 7-10-year debt? What can we do? HUD debt is awesome because it's 40-year debt potentially. You can get really long-term debt. It's going to be in a much better position. So, but I think, in those situations, it's just really understanding what has happened that hasn't gone well, and what can you look at going forward. So again, I don't have a specific crystal ball for it, and again, what the issue that caused an issue last time is not going to be the issue for next time. It's just really paying attention and understanding, okay, what are the issues again, what are the levers here? And when you get excited and you're new, you don't know what you don't know.
Yeah. Do you see? I think there's something to be said about following trends as well in the market, because one asset class might be great in 10 years ago, which a bunch of people have stacked on into that asset class, and now a lot of that opportunity is gone. Do you look at opportunities the same way, or are you very you believe in certain asset classes through and through? Is it deal by deal? I think of right now, I think mobile home parks, for example, as inflation rises and it gets tougher for the average American to live, I think, that is a great asset class to be in. Whereas, or maybe even senior assisted living, right? I think there's a short window over the next 5 or 10 years where senior assisted living is going to be hot because of the silver tsunami and how many people are getting into retirement. But after the next 5 or 10 years, that demographic is going to be shrinking. And so I think there are trends. When I look at deals like that, how do you look at the landscape?
Yeah, so it's a great question. We look really, and I talk about this in my book, I have kind of a deal funnel analysis where you start with specifically what's the market, right? So I go market, I go operator, and I go deal. Now it comes to you in the opposite space. It comes, here's the deal. Yeah, if you're like me, you get a bunch of deals. Who knows how they get your email? You get this deal in your box, your inbox. And you have to kind of step back and say, well, hold on. Well, what market is this in? Is this multifamily in Dallas? And what part of Dallas? Is this senior assisted living? And what area? So you've got to kind of look and say, okay, well, what is that specific market? Like you're saying, if you're in a market where it's growing. So, for example, we're doing a senior assisted living, independent living place in Fayetteville, Arkansas, and we're really excited because in that area, everybody's on a wait list. I mean, we're talking like, 1-2 year wait list for those type of things, right? So there's incredible demand. And so we love being in those spots because when you're in there, it means that, okay, there's nobody else coming online and we're just seeing incredible demand there, right? So, so those are the types of things we look for and it can be in oil and gas. Well, what's happening with oil and gas? Well, we think there's going to be constrained supply, maybe not immediately, but over the next few years for a lot of reasons. And so, I think whatever you're doing, it's just thinking about, well, what market is that in? If you're in the rising tide raises all ships. So if you're in the right market, you're going to do very well. So real estate, different assets, I try to look at that. And then we come down to the operator. We talked about some of those operator questions of who's doing it. And then finally we get down to the deal itself and we say, okay, what does this deal actually help me meet my goals? Does it actually, if my goal is cash flow, and a lot of people are very unclear on what they want. They'll say, oh, awesome. Do you want cash flow, appreciation, tax benefits? Like, oh, I want some of everything. They really don't know. And for most people, cash flow is transformative. If you can start developing cash flow, it's transformative. It's harder in real estate these days, but it's really powerful. Tax benefits, if you're a high earner, as we mentioned, oil and gas does a lot of that. So I think it's really trying to figure out what it is you're looking for. So we look at it from our investors. Well, what are our investors looking for? Right now it's cash flow. Right now it's cash flow and some tax benefits. And so we're doing deals that produce cash flow and tax benefits. And we're doing other types of deals too, but we try to really think, okay, what do I need? What do our investors need? And then we kind of try to go after that type of deal in comparison to kind of our other offerings. So we don't want to have like 5 different debt funds. And, we want to have, okay, we have a debt fund. We've got this, we've got, what are some things that kind of fill in for folks that can really kind of help them on their way. And so the nice thing when you're an investor, if you do different asset classes, you don't have to choose, right? You can say, I can be a multifamily real estate investor on this one area, or I can do other areas, or I can do other types of real estate, or I can do oil and gas, or I can do debt funds, or I can do VC, or I can do other type. There's many different things you can do. So you figure out what makes sense for you, and then you can pursue that. So that's why I like kind of really being open. I think there's a great time to invest in a lot of different assets, depending on the time.
Just from the couple times we've connected and talking through this, I think we come at this from maybe different sides of the spectrum. I feel
Right.
like I'm maybe more black and white, and I think you're gray for this example. My thought here is my current take, and I'd like your take
Yeah.
on this.
Sure.
Is I think I'm a firm believer that you need to have a primary objective investing. So it's either equity growth or reducing your taxable income or focusing on income.
Sure.
And I find that most people that come through my door when we're doing coaching and I'm trying to help them, figure out what deals to invest into and how to maybe build their portfolio in alternatives, they come in just like you said. They're saying, oh, I want a little bit of all three. And I find that like the typical multifamily deal, for example, they're like, oh, I want some cash flow and the tax benefits. And it's like, okay, well, like the incentive structure, like if you're doing a multifamily value add deal, like for 2 years, you're not getting much cash flow because they're doing the value add. And then you get cash flow after they refinance, but you don't really know how much cash flow. So you can't really like
Yeah.
rely on that. And
Sure.
then the deal will flip in 5 to 7 years because the operator makes their money off of when the deal exits. And so,
Right.
you're not really relying on that cash flow.
Yeah.
And so, yeah, I would love to. How do you think about that?
Yeah. So, and I'd say it this way. I'd say, and I think, yeah, you said you're a little more black and white. I would say I'm there's more color there. I have a little more color, maybe.
Color,
I'm
yeah.
an artist. I'm a songwriter. I kind of see possibility and ideas, and again, this is not a right or wrong. It's a different way to approach it. And so I think that's what kind of, I do think it is very important to know what your investing goals are. And like you said, people are like, oh, I want a little bit of this, a little bit of that. But you're right. I mean, right now, multifamily, it's very difficult to find cash flow in any multifamily deals. Like it's very difficult to find it. It's that's why we've shifted to other assets that produce a lot more cash flow. And for most people, that's their primary number one thing right now, because they've had deals that have suffered. Maybe they were producing cash flow, but they're not, or maybe they've had capital calls and they don't have the cash, so they got to figure that out. So again, getting really clear on what it is you need. And some people are, I think sometimes the cash flow and the tax benefits can go together with the right types of deals. It's got to be the right type of situation. But yeah, I think it is really important to get clear on what you want, because for most people, just investing in something that may offer some of those things. Even this is another one I've seen a lot. Oh yeah, I just want the highest total return I can. I'm like, well, what are your goals? Like, are you trying to quit your job? Well, if you're trying to quit your job, a lot of money in 5 to 7 years, like that's not going to help you now. That's not going to help you get closer to the number. And then once you get that money back, like, what are you going to do with that? Are you going to reinvest it? Are you going to cash it all and use it for something? Like, you don't know. It's so far down the road. So that's where we like deals that cash flow like immediately or almost immediately, because cash flow actually reduces your risk basis immediately once you start receiving cash. So if you have a deal like an oil and gas, or you have some sort of other types, we've done oil and gas drilling, and as well as royalties, or other types of deals that just, the debt fund, whatever it is that you're getting paid back, it actually is reducing your basis every single time you get funds back, every time you get a direct deposit back. So I love that. And then also I have a theory that if things are cash flowing initially, they tend to continue to cash flow. Now, there are times where I've seen some multifamily operators over raise and pay a distribution just based on the fact that they want to have a monthly or quarterly distribution when the deal doesn't really warrant it. It's like if you're starting to pay it, like you're doing a value add deal and you're getting like your first distribution in 60 days or 90 days, like that's not really happening in the deal. It's almost like a false narrative, right? And
What's your
so,
take on that? I see that often. And and
um,
and and it does work. Like investors
yeah,
are drawn to it.
yeah, I think it works when it works, but I think you're just basically introducing in general lower returns. You've got to be a little more aggressive in your numbers when you do it, because people don't want to invest if the numbers are too low. And so if you're saying, oh, it's going to get this amount of return, and I've seen groups do it where they kind of trickle out. I mean, like literally just trickle out, like here's $20 a month or something. Like I've seen it, like here's your $19 a month or something. You're like, what is this even doing anything? But psychologically, at least you're getting something from a deal and there's something coming back. But I think it's important to look at what you're getting back, how much you're getting back. And yeah, I don't know. I mean, I think it used to be a little more common when deals were just, it was a little more, hey, everything's kind of improving, everything's going up in value. Well, the last 3 years, we're not seeing we're seeing a lot of deals still at 2016 to 2018 pricing. And so if that's the case for multifamily, it's harder to find. I think there's a long-term approach there. There's going to be some point where say, I'm so glad I bought all this stuff in 2025 or 2026, but it's taken longer than we thought, right? For all was it survive till 25? Remember that it was survive till 25. Now it's like, just keep it going, do the best you can, And so I don't know. What are your thoughts on that?
Yeah, I mean, I think it goes back to what is the purpose of investing in a deal. I've invested in a deal with Grant Cardone
Okay.
here in Miami, and
You
it is a
10x your life.
scenario. Yeah, 10x, 10x. And the reason I invested in the deal was for a 10x, right? Like not the 10x, in jest, but for equity growth. And
Yeah.
they pay out $83 a month,
Yeah. Right. Yeah.
since we bought the deal, and that's not what I'm investing for. It is nice to see the deal, to see the cash flow. I do think there is something psychological about
Yeah.
it.
Right.
But yeah, I don't know. I have mixed feelings about it. I think I would rather see, if it's a value add deal in any asset class, I would prefer to just not have any cash flow and have all of that go into the value add or the reserves, because I'm not, that's not what I'm investing for. And you're right. I think it lowers the initial return, or you need to raise more capital. And I think there's pros and cons. I guess there is no definitive answer, right? Like you can
Yeah.
choose whatever style you want.
Well, and like you're saying, I mean, a lot of investing really is psychology too. Like we realize we love seeing a direct deposit in our account each month, right? And so I have a deal we're doing. It's an oil and gas land player royalty deal where we're buying land that is, owns, it has existing, oil and gas wells on it that we do not operate, right? So we're the landowner of these wells. And so, for example, one is 3,000 acres with 140 wells on there. And the fund, I mean, from day one, a lot of these purchases are producing over 20% cash on cash, which is huge, right? But we're not returning that to investors immediately. We want to actually let some of that compile up, because when the guys in the northeast section of that land want to drill another well, we have the right but not the requirement to put 20% of the money toward that, right? So we can dramatically, it's like a value add deal, right? Real estate, we can increase the value of that by doing that. And so it should lead to a much higher multiple over time. And so sometimes there are deals, just like you said, in a value add deal, but there's a psychological thing when you're getting paid, and you're getting paid well. It's like, it feels really good and you don't want it to stop. And so, but long term, it's a discipline, but it's psychologically, I've just watched investors kind of deal with that. Where it's like, oh, where's the money? What's happening? And it's like, when the money's, oh, the money's coming. And it's like, just because the money's coming doesn't mean the deal's doing well. I mean, just because the money's not coming in your bank account doesn't mean it's not actually thriving right now.
Right. I mean, I think there's the same thing that happens with quarterly versus monthly distributions, right? Like, I think all things being equal, as an LP, you want to see monthly distributions
Right.
versus quarterly.
Yeah.
You've raised quite a bit of money from different LPs, and I'm being in the industry. You've had deals go well, deals not go well. I imagine there's many different types of aha moments that your LPs have when they invest in these deals, maybe even for the first time or their first couple times, where it's an educational experience for them. Can you maybe talk about some of those educational experiences of maybe things they didn't realize going into deals, or yeah.
Yeah, well, it's really interesting. This is a very different world than a lot of other types of things. Like when I go to Chipotle or I go to McDonald's, I know exactly, or I don't go to McDonald's, I go to Starbucks. I know kind of what the experience is going to be, right? I go to Starbucks, they know what my drink is. They'll say, okay, this is it. And I'll kind of know how that's going to go, how the person's going to treat me. When people invest with different groups, they really don't know what to expect, and it can change from different assets. So we have, for example, this debt fund I keep talking about. It takes about, typically for most investors, it can take sometimes a couple weeks. Sometimes it's usually about 4 or 5 weeks to actually deploy the funds, because we're actually working with a direct lender that's actually deploying this. And sometimes it can take a little bit longer. So sometimes it can take 45 days. It can take a little bit longer, or maybe 6 weeks. And then it takes 30 days from there to actually accumulate the first monthly payment, right? So the biggest thing that I've noticed is just trying to set those expectations, and then even working with my partner on that, and just saying, hey, let's make sure that we really send an email. Hey, here's what you can expect, right? And because a lot of times people don't know what to expect, right? They don't know what to expect kind of going forward. And I think it's great as an investor to just ask lots of questions and see how people respond, because they should be more than happy to take your calls, answer any questions you have, whatever. Now, if you're calling them every day or every week, that's a lot. But if you generally have questions, you're emailing and you're calling, and especially when you're new, or you're inquiring, it's like that should be priority one for them, like getting all of those questions answered, right? Because you've never invested with this operator before, right? So you don't know what their experience, you know what they're really going, what the process is. So I think that, I guess the aha moments are just, I've noticed a lot of LPs are surprised when things don't go kind of with what they had expected in their mind. And it could be that maybe we explained it, maybe we emailed it, whatever, but there's just a lot of times people don't know what to expect. And so it's okay to be like, hey, I don't know what to expect here. What should I expect?
Yeah, I find that one of the things that I didn't do early on, which I do now, is asking, can you send me what your reports look like from
Yeah.
past deals, so that you understand what that communication looks like, or, and then you'll know, are they doing those reports quarterly? Are they doing a monthly? Or are they doing a webinar? Is it just words, or is there data along with the reports?
Right. Yeah,
Yeah.
that's it. Yeah, because and that's kind of goes with, what is it? What's the experience you're going to have of investing with them, right? So the reports are part of that. The talking with investors, I think, people that have currently done stuff with them over the years, and because you don't know until you've actually done it.
So you also are kind of shifting a little bit towards maybe doing some of your own deals. You talked, I hinted a little bit at the beginning about you working on this modular project in Altadena, California, and you also have a debt fund that you're newly raising capital for. Can you talk to us a little bit about those opportunities?
Yeah. So one of the reasons we want to be an operator is we were talking before we started recording, we've had, a deal or two that hasn't gone well, right? That it has not performed the way we wanted to. Either there's been a loss or capital call or some issue. And, not that if we were running it, we wouldn't have had the issues, but in some cases, yes, if we were running this, we wouldn't have had these type of issues. And so, as somebody who raises capital and does deals, it's great. But when you actually can create a business, if you have a great business, capital is not as much of a problem because you have a great business, right? So I think that we've kind of got, not that we've got that figured out, but we know we can raise capital. But if you have a deal that just is a really well put together deal and it performs well for investors and it really has a great cause, like rebuilding in Altadena and doing some of these prefabricated homes that can be just built much faster and still receive retail pricing, there's a competitive advantage there, right? If it costs these other guys, 650 to 850 a square foot to build, and we can do it for 400 or 500, like we have an advantage, right? We have a big advantage. And so we've been looking at that, and so I guess that's one of the sense of wanting to be in the operator seat. The other one is the debt fund is a little kind of a different thing, where we just found people want to have monthly cash flow and they want lower risk. And so if we can do that, that's what really we can offer to them. And again, we have a great relationship with these guys, and we've actually worked with them for a couple of years, and we've raised several million for them. So we've had a great experience. It's an evergreen type fund, and so it's ready when people are. So again, it's just trying to find out what really people are looking for. It's like, hey, I want something low risk. I want something that's not like as high risk of some of these other things that didn't go as well, right? I want something I know it's going to be stable.
Yeah. Well, let's dive into the Altadena deal. I imagine um, you're a little bit more dialed in into what's happening there after all of the fires. Talk to us a little bit about the dilemma that's happening out there and what opportunity that creates.
Yeah, so I live about a mile and a half from the fires, where things from my house, you could see it the night January 6th when things started. I believe it's January 6th. Things started burning, and it just within the next 24 hours, like over 6,000 homes had burned. It was really just tragic. And we left our house, and our house was fine, but didn't know, like, are we going to come back to a house? Is it going to be there? Is it not going to be there? It was a really scary
That
feeling for
sounds really
several days.
scary.
Yeah, it's really scary, and you just don't think about how how traumatic that can be. And I didn't even lose my house, right? So there's people I know 7 families that lost homes, and so I started saying, what can I do to help? And so one of the issues, California does have some red tape as far as building. They make it difficult, which is challenging, but it also makes it, if you have a way that's creative, it can be helpful for people. One dilemma people have here is that they were underinsured. The states made it very difficult to get insurance. Either they didn't have insurance or they were underinsured. And so at the higher build price, some of them can't afford to build. They can't afford to do it. And so that's where we found, if we have a cheaper way to do it, we can do a 4-bedroom, 2-bath house that's 2,100 square feet, just for less than $300,000 that can be built, right? In California. And it's interesting, this works really well in high labor markets because it's like you're not having to pay for that. This is done in a factory, a couple hours away, and then it's put on trucks and shipped over here and installed in one day. And so we really like the element of being able to do that and be able to do it quickly. One of the challenges we've had is that now that I've gone through the licensing process and all this, and I'm there, that's a whole process in itself, but it gives us a significant discount on these on the units themselves. But one of the issues is, if we build now, I think we're building too quickly versus these other, like, you want to be able to comp with new construction, right? So if we want to sell at retail prices, we realize, like, man, like we would not be getting, like, what would make it, wouldn't make as much sense now, right? It's more of kind of like, well, if we do really well, we can make some money. Like, if we position and do everything perfectly, we want to have some margin there so that investors can do well as well. So we thought we're going to wait until we start seeing some of these other new build comps go on the market. So that might be another 6 to 12 months, and then we'll be able to start cranking out things on the investment side. And so in that meantime, we're going to try to help people to build and try to help them to get going on their stuff and put some in there and see how they like living in these. But I've walked through them. These are granite countertops, and they have unique ceilings and all kinds of cool porches, and all, you can do kind of whatever. And these are they don't look like a double wide. They look like they have different tiers and shapes, and you can do 2-story. You can do all kinds of things. So it's pretty unique what you can do.
It's crazy how the permitting process and the rebuilding hasn't happened, and it's been delayed. Like, do you have insight into that? And, like, I mean,
There
you're
are there
you're
are people
there.
building. Yeah, there are people building now, and it's, I would say, the challenge is, like, I don't know if it's necessarily that they're slow here. I think it just takes time. It's like people, if they had a property, they had to have the Army Corps of Engineers come and clear everything. They cleared all the toxic debris. They took 6 inches of dirt off of every piece of land. So anything that could be toxic is gone. They had to go through, do some testing, whatever. And then, if you have plans, if you have plans and you have a builder, there's typically a lot of back and forth process to that, right? So it's like, oh, we're going to do this here, or whatever. And then there's a revision. Oh, there's this, and we got to do this. So it takes most people 6-8 months to kind of go through that process. The nice thing about the modular or these manufactured ones that are built in factories, they're actually pre-approved on a federal and a state level already. So when they for locally, when they put these in Los Angeles County, they simply say, oh, okay, what's your site plan? Well, these are pre-approved, whatever. And it's a much faster process. So it should take about 4 to 8 weeks, because you shouldn't really have revisions once you've submitted all your plans, because you kind of know what you're going to do, right? So there are people building, there are people putting temporary things, there's people that are there. It can take people a while to figure out what they want, and then for their permits and their other things. But it's, building a house for an ordinary person that lost a home, that's a lot of learning. They got to figure out all that, right? They could hire a developer and do it, but it's way more expensive. So a lot of people are trying to figure out themselves, and it's just a learning process that can take you 6 months just to figure out what you need to do. And so people are just now kind of starting to get going and submitting plans and doing all that.
So it sounds like there's opportunity, right? Like wherever there's tragedy, or there's also opportunity. So it sounds like there's opportunity for investors and builders in that area. What else? I mean, right now, as we're filming, we're near the end of November. Stock market is tanking. How do you kind of view the next couple of years for real estate investing in relation to the broader market?
Yeah, it's an interesting time right now. I think in general, a lot of real estate doesn't make a lot of sense, because in single family, people have these 25 years left on their mortgage that's sub 3%, a lot of them, so they're not gonna want to sell. And then when you're buying stuff new, it's like, well, is this going to cash flow? If I'm going to do a rental, a lot of times it doesn't cash flow. It is negative cash flow. In California, what you could get here that would you put $1.2 million into, it would be, your payment would be 10 grand a month, and rent would be 4 grand a month, right? So it's a negative, like it just doesn't make sense. There's certain markets of the country it makes sense, but for a lot of places it doesn't make sense. And so I think that's the same with larger multifamily deals. I think it's going to be interesting to see if rates do drop and see what that actually does. There's a lot of speculation. I was at a Tony Robbins event recently. He's a big motivational speaker, and he was
Big
saying
fan.
that, yeah, I love Tony Robbins. Over the next 5 years, he said, we're going to have more change to human life because of AI and robotics than we've had for the previous thousands of years, right? So that's a big, like, if that's true, incredible displacement, right? There's 8 million drivers in the US that drive trucks or Uber or different things. They could all be displaced, right? We could have accountants, we could have all kinds of different professions that are just, oh, we don't need that anymore. We found a way to automate all that, right? There's going to be a lot of changes. But the one thing I will say is, even if real estate doesn't cash flow now, there's no technology in place that is threatening that somebody would not need a place to lay their head or a roof over their head. Like we don't have any technology that's going to do away with real estate, right? Maybe that will happen eventually, like go on your little pod at night or something. But I mean, it's going to be here, and that's where I think you can't AI away real estate or any sort of ownership of assets. And so that's why I think owning real estate is valuable. But it is a bit of a crapshoot to see what it's going to look like. I love real estate right now, investing if you can find deals that make sense. It's just hard as somebody who raises capital for deals. A lot of people are not very excited about a lot of real estate, especially when it comes to in multifamily. It's like a lot of people got hurt on that, even though I think it is a good time. I just think it's a lot of people, are not excited because of what's happened in the last few years.
Yeah, I mean, I'm still a big fan. I still am very into affordable housing, and as I mentioned, co-living, rent by the room that I do. I still think there's a ton of opportunity there. Something that's just on my mind is this idea of, like, okay, if all of these people are going to be displaced in the next 5, 10, 15 years, what are they going to go do? And because I'm imagining we're talking like tens of millions of people across all types of industry. And where is the check going to come from for people who own multifamily or residential
Yeah.
housing?
It's a great question. We don't know. I mean, they say we have, millions of need for different types of jobs and supporting robotics and different sort of, types of things, services. I mean, you can't AI away a robot away a plumber or a lot of different, different things. But I think we don't know. I think this is where what people need to be doing is we need to be educating ourselves, spending time in Chat GPT every day, asking the hard questions. Hey, if I'm doing this, what are some skills I should be learning? What are some opportunities? And I think it's important. I think it's important to kind of spend time to continue to look, because I mean, literally we're waking up every day, every week. A lot of significant things are happening. And most people, especially over the age of 45, are not paying attention generally. It's kind of like, oh, I've been doing this for a while, whatever. It's like, well, things are good until they're not. And it's like, we can either be proactive and try to learn and, learn some new skills and do some new things. But that's why, being a real estate investor, especially, or finding ways to produce income through investing is really valuable, because it doesn't make you reliant just on simply a job.
Yeah. Bronson, this was a lot of fun today. Where can people go find more about you, learn about your deals, your platform?
Thanks, Pascal. This is a blast, man. I'm excited to have you on my show too, the Mailbox Money Show. I have a free gift for your audience. It's a guide on inflation, of how to use inflation to your advantage. The obvious ones, obviously, are real estate. There's some other ones in there, precious metals. There's borrowing. There's different types of things you can do in times of high inflation. And I think the inflation is much higher than officially reported. So if you text the word inflation to the number 33777, just text the word inflation to 33777. We will go ahead and send that to you, and then you'll hear about kind of what we're working on in the future. But really great to be here today, Pascal.
Hell yeah. Great to have you on. And thank you, everyone, for joining us again. This is Pascal on the Passive Income Playbook on the Best Ever CRE Show. This happens every Thursday. Feel free to reach out to us on LinkedIn, YouTube, whatever. We love hearing from you. If this episode you caught something, and we will see you next week. Take care, guys.